What is going on, everybody, and welcome to another weekly update. And what I like to do in these videos is provide you guys some upcoming earnings, some upcoming events to get you prepared for the week ahead. If that sounds like something you're interested in, consider subscribing, as I do also do a technical analysis on Sundays as well. And so you can subscribe and check that video out. But with that being said, I also am on X at Hemi137, where I do daily pulses on the market, as the market is dynamic and new data can swing the market in any direction very quickly. So, with all that being said, remember to hit the like button and let's go ahead and roll this weekly report out. Now, one thing that is interesting is what we're seeing, and something I've talked about to this point is we're starting to see a bigger acceleration when it comes to job reports. And this is putting a lot of pressure on the Fed to start talking about rates. Now, rates have been getting talked about. Essentially, there was the talk of a 25-point basis move coming in about another week. So we got about another after this week. We'll have a we'll finally get the rate decision on what's gonna fall. A lot of people are weighing it may be 25. There's been some suggestions that it may be even 50. A lot of people are saying that essentially the Fed needs to start cutting now, or potentially they should have started cutting back in July, and they have not. That this is going to start getting wildly out of control if they don't start cutting rapidly. So with that being said, let's look at this past week. It was a very short week, but what we've seen is the market itself has been pulling back. This is why I highly advise that you subscribe, because then you can check out the technical video on that. But ultimately, as you can see in the column on the left over here, we got a lot of red going on over the past week. It's been that way essentially since September. We haven't had one green day in September. I've said that September is normally pretty much a pretty bad month in general, but now we're starting to get a lot of negative news on top of that, which is not helping, and it's primarily based around jobs. Now, this past week, we did have the non-farms report on Friday, and essentially we've had 142,000 jobs added versus the 164 expected. The June-July job reports have been revised lower by a combination of 86,000 jobs. So again, we're continuing to see massive revisions on what's going on with this. And this is not even talking about the year over year, the massive revisions that we're about ready to get that once it becomes official. 11 of the last 15 job reports have been revised lower. And that's not even, again, final numbers. Like I've stated before, when this whole thing started getting kicked off, first it was inflation. Once inflation they had more of a grasp or more of a control of inflation, that the biggest concern would start being jobs. And that's what we're starting to see. We're starting to see a massive acceleration and more job losses. Again, with high rates, companies cannot essentially afford to have more people on payroll. And so with that being said, you're starting to see this push down. You're getting a lot of pressure on essentially small business, and small business makes up a massive portion of our economy. And so with that being said, you're going to have to start cutting. Now, the problem being, and this is something I keep reiterating, is people say, well, once they start cutting, everything will be fine. Well, we have to understand, again, where all three of the sectors are. Where is business going to be at that point? Right, business has to recover, which will probably be the first ones that will recover fairly quickly. Then you have the banks. The banks aren't going to want to lend in a recessionary period. You have to understand, they have already been closing bank branches because they're concerned about what we don't know is what's their books aren't brought to market. So you don't know how much money they're actually underwater for, which if you actually knew, you'd probably be extremely frightened. And with that being said, you also have the consumer that's in horrible shape. They essentially have blown all their savings. I think it's up to about 75% of people cannot pay $1,000 emergency expense if it's needed, and that's the concern. It's been so much. Essentially, the government has allowed people to take out essentially $1,000 a year, which I think is kind of a joke, especially with this inflationary environment that we're in, and they without any tax penalties, but you eventually have to pay it back. I think within like a year or 3 years, some short window, something like that. But nonetheless, people are working. Right, historical data has been showing that people are working 2 full-time jobs at this point. So you're not taking a lot of these things into account, and that's what's the concern about what's going on with these reports is you're not seeing the full picture and understand that we are losing tons of full-time jobs and people are taking on multiple part-time jobs as well. And you have to essentially understand the sum of the average, right? And understand that one of the biggest workforces that we've ever seen in our history is retiring over the next decade. And so this is why they talk about this massive transfer of wealth that's going to occur over the next decade because of what's going on. And so these are things you have to keep in mind when you're talking about these things. And so when you're looking at the jobs report, we've heard from Jackson Hole that the Fed will start cutting. Now, this is something I want to bring up that I talk about or I've been talking about primarily because of Jackson Hole. And I relate this back to 2007, 2008. With the great financial crisis, and people don't want to compare. Again, mainstream media is going to tell you whatever they want to say. That is not the same. It is the same. You have a broken banking system that essentially massively leverages. For every $10, they can leverage that like 100x, and that's what they do. And they roll out these packages, and so you have this massive bubble that keeps bloating and bloating and bloating, and eventually a burst down, and you need to normalize pricing because it's just too massive, and that's what you're starting to see unfold. Now, the only thing that's been saving and something I've been pointing out is that they've removed the debt ceiling over the past year and have been free spending to keep this economy propped up with government jobs, which I don't know if they actually exist, but that's been propping up GDP numbers, which they've talked about needs to be or is going to be revised down as well. There's a lot of, again, around job numbers. We've seen the massive 818,000 job revised down. That's not official numbers, which they're projecting to be well over 1 million. And so you can see where things are really bad. If you haven't been affected by what is currently going on, you're sitting there scratching your head. Well, why are they telling me things are good when in fact that they are not? And some people have been affected in some way, shape, or form in the current environment, and understand how brutal it is right now for a lot of families out there. So people are at the point to where they're even starting to skip meals because things are so bad. And coffee, again, one of the highest inflationary items, because again, people are working multiple jobs, so they'll at least have a coffee because they can at least try to get them motivated to get through the day. So being said, we're seeing massive going into September 18th. September 18th is the big day. Something I want to really emphasize, and relating back to Jackson Hole, before I lose my train of thought there, is back in Jackson Hole 2007, they started with a 50-point basis move, and they did two essentially 25-point basis moves going into 2008 year. Now, what we saw, and this is why I mentioned this, you need to know about the cycles. Your yearly cycle is typically you pull back around the March period, and then you have a pullback September, October, or normally your two biggest corrections in the market. And during the 2008 crisis, there started to be some massive cutting going on around that March time period. And then there's a huge cut in December when we had that massive sell-off for 2008 that essentially led to the crisis. So you have to understand how this plays out. What we're looking for on September 18th, 25 points is kind of a joke. It's not really going to do anything. They're still concerned about inflation. You got an election. So that's kind of what you're looking at there for the September, is that depending if it's 25, it's not that really big of a deal. They're not really committed. You start seeing commitment in the Fed and rate cuts that this is really what we want to be doing when they start hitting 50 points. And then you start seeing panic when the Fed start doing 75-point basis moves, and then extreme panic when it's 100-point basis moves. Now, you had some members coming on talking about, oh, well, we might actually be in a recession after a whole year of all you heard. It's probably longer than a year, because it was supposed to be the most anticipated recession because people are much more informed now, and institutions had a lot of money sitting on the sideline. This is essentially why they didn't want this administration to be blamed. Plain and simple. So they essentially removed the debt ceiling and they're spending like crazy to improve GDP numbers, to improve job numbers, to try to push this thing out to where it is right now. And the problem with this, with doing this, is that you make it's going to be a lot worse. You're amplifying the problem, as you postpone this until whoever sits in office in February is going to inherit a hot mess when the debt ceiling comes back in the first of the new year. And then again, so all these bailouts you're doing for the banks, all this $185 billion that's going to illegal aliens for food and housing, all that could go away because now you're under a budget again. So you're not free spending anymore. You're just trying to get a vote. And you have to understand that this is not political. This is the way it works. And you have to understand it's for the banks. The banks lobby politics, right? And so you have to understand the banks call the shots. And if you see the manipulation, if you're in the market long enough, you see this happening all the time. And so to just go blindly off of headline news, you have to understand they control the narrative. And I talk about this utopic perspective. And while you're scratching your head and wondering, well, I don't understand why things aren't so bad. Yes, some areas in the housing aren't doing bad, but we're starting to see housing turnover in a lot of real popular areas. And you have to go over the general consensus, not so much what may be happening locally. And then you have to understand, depending on your career field, yes, it could be good, it could be bad. And so that's what you have to understand is you're seeing very, very extreme times in some cities and some jobs, but ultimately understand that the freightliners are shutting down. That is the pulse of the economy. If nobody is buying, UPS, right, FedEx are been getting hammered. Nobody is shipping anything. So there's like no production going on. That should be your key indicator that there's nothing going on. And some of the worst, this is like the most historic time for a lot of these freightliners and for, again, these delivery systems that are currently going on. They are suffering by extreme measures. And to think that, we're just going to prop ourselves up by just printing money, and that when the rates start coming down, things are going to get better. They have a while. It's a turning point. This is why I say the market will price in a recession, which an average recession is about 42%, give or take. So it could be more than that, could be worse than that, maybe worse because we're reflecting numbers back from the Great Depression. I believe we're in a depression and not just a recession at this point. And then all that stuff, they don't tell you up front. And that's the thing you have to understand is people that have been in markets for a long time in these cycles, you have to understand that once you go through a cycle, you'll understand, well, that makes sense now. Before, it may sound like you're shouting on the rooftops and everything else, but you try to take advantage of these cycles, and you're sitting on more cash right now because the cycle is going to play out eventually. And then when the cycle corrects, then you take position. Then then at that point, then you go all in. I've been talking about this for a couple months, that you need to be having a list of things that you want to be buying, and the market will recover first, and then your automobiles, right, will correct shortly after, and then you'll have essentially your housing after that point. The housing will correct over the next decade because you have, again, a bunch of retirees from the biggest working class that are going to start rolling over because they just are, they may be passing whatever the thing is, and these kids will be inheriting these houses, and they're not going to want to live there, right? They just want the cash, so they'll sell the house for the cash. And so, again, not trying to get on an epic rant, but we're seeing a lot of things that we have been talking about to this point, and they're accelerating. And I said about a month ago or so, it's going to start accelerating worse and worse and worse the closer you get a recession, because what's going to happen again is it's all going to be offloaded. If it doesn't break before Christmas, it will definitely break after you have a new sitting president. So with that being said, again, not trying to make it political, but you need to understand it's all navigated by the banking system. And there's been presidents in the past that have tried to stop the banks and have done well, only to lose again. And they're very overpowering, right? So learning a little bit of history about the banking system is extremely important, especially if you're in any kind of market, because all markets will be affected by the economy. Being said, this next coming week, we have the core CPI on Wednesday, which is going to be extremely important. Inflation is going to be the next thing to watch. And this is something when I've been talking about my technicals, is what I'm watching is bonds, first of all, because you start getting massive rate cuts, your bonds are going to go flying through the roof. And the next thing is potentially commodities. So when you start lowering rates, your commodities start skyrocketing. And what has been really odd is there's been a lot of manipulation going on with oil. Oil is dropping despite some events that have been occurring, and then ultimately understand that typically, again, when you start cutting rates, commodities start flying up, and they're talking about a potential super cycle with commodities and concerns about inflation roaring back when we start cutting. So kind of looking at that 70s era with inflation, some of the worst inflation we've ever seen, and how we thought we defeated inflation back then. And then, inflation came roaring back even worse. And you think 9% was bad about a year and a half ago. It could get a lot worse than that. And that's what we may be living through over the next year, which is why commodities are going to be something we really have to watch when we start cutting rates. So, core again, we'll watch and see. At this point, the Fed is more concerned about employment, so this core would be extremely important. If core starts to creep back up, which we've seen them manipulating the reports anyway, to get it below 3, taking out essentially anything that has inflation that really matters, and then understand how that is heavily manipulated. And we also got the PPI on Thursday. So again, because of what the core is going in, leading into a big week, you have the jobs numbers and you have core. It's going to matter a lot because that's going to dictate the size of the price cut next week. And so this is why they matter a lot more. And so I say some events will start getting more weight during specific times. This is why you need to know. This is why I make this video, so you know kind of the pulse of the market, and I go off events. Well, okay, now this event weighs more than it normally typically would because now we're waiting on rates, right? I've essentially navigated you through this whole couple months and what to be watching for. Try to take advantage when to place more risk on. You need to wait for some event to happen to understand, well, okay, now the events happen, so I can place some more risk. And this is why institutions are a lot of cash right now, because they need this recession to be priced in first. Once we've seen some heavy selling and there's some good positioning. I've started some positions like I've talked about. I've taken position in oil. I've taken position and bonds, because we are at the cusp of all this stuff starting to turn. And then when it turns, that will sell off, some of the bigger lists of things that I really want as far as in the growth side of things and some value things, and then invest heavily in those as this market starts selling heavy, right? That's when you invest, because after that, I think, yes, we'll start recovering, and then we'll go back into another decade of only up, right? But we need a correction first. We don't know how big that's going to be. So you need to be slowly DCAing and not just heavily throwing money in there at one time, right? So these are just things you need to keep in mind. So monetary policy, obviously that's next week. So we're really looking forward to that one. And it's going to have projections. So it's going to be really volatile next week. You need to understand that. So depending, again, what happens this week will dictate whatever cut will be next week. And then we got 2 more cuts before the end of the year. October, we don't have any monetary policy, so keep that in mind. And then we'll have to determine from there. Core, obviously, this week. And then October is what we're really watching there. Upcoming earnings. Again, news cycle doesn't start till October, so I'm not going to bring up any earnings. There is GameStop, which is, I guess, our honorable mention, just because of the Roaring Kitty came back as well this week, or did post something, so you need to keep in mind. Now, expected moves. If you don't watch me at all, you should notice that this number is massive. They are pricing in 133 points on average. It is only about roughly around 60, 70. So they're pricing in a lot this week because, again, the core is going to dictate the price cuts next week. We've seen more and more revisions. The job losses are adding up. Again, this is the problem, is you have massive amount of job losses that are reported every Thursday, and then you have a non-farms that's reflecting, no, it's not really that bad, but it's starting to reflect that it is bad. And then you're getting these massive revisions that are telling you that SOM rule has been triggered months ago. It wasn't just triggered last month, it was triggered months ago. So nonetheless, we are leading into this. You can see why when I talk about how things may weigh more, because you'll get an event that happens that places more weight on specific other events that you need to be paying attention to. So Again, SPX, massive price in. So again, if you're playing options, this is not the week to be playing options on SPX. Individual stocks, yes, but as far as the SPX, no, you're not going to want to play options unless you're playing futures, which has been a common theme over the last couple of years because they've just been pricing in so much for options. Now Tesla, again, pricing in a lot. So you got Robotaxi coming out. They just announced news as well this week that Robotaxi is going to China and the U.S. I believe the U.S., but definitely China. China is a front runner on that aspect of it, but and they've sold off heavily. And again, if you get some really high inflation, that's going to drive a Tesla down. And this is why they're pricing in so much, because if for some reason inflation goes high, it's going to handcuff them in the next week. The Fed said it's more important at this point to be paying attention to essentially what's going on with unemployment. And so if inflation starts to rise, and this is where they're pricing in so much. If inflation starts rising again and your jobs are really bad, what that's going to mean is next week's only going to be a 25-point basis move. And then the big concern and the big weight is going to be shifted back onto inflation, as we're going to relive the 1970s and potentially get a big reoccurrence of inflation. But because unemployment is so bad, the Fed have no choice but to have to cut rates. And so this is where they're talking about this huge potential super cycle could happen with commodities because of that fact. So this is what you need to be paying attention to ultimately. And Boeing, again, it's up 2 points, which again, Boeing typically only sits around 6 points. JPM's up huge 2 points. JPM barely moves a point. And the fact it's up by 6 is pretty astonishing. So the market is pricing in a lot this week for options. They don't obviously want people to be essentially profiting off of options. And considering that 0 days have been on essentially the cusp because everybody's a trader now, you're essentially left having to swing trades as shares or play futures at this point. And so this is why I say the market is always changing. You need to know what tools you need to use in what environment. And that's why this kind of video is important, because I adjust my tools compared to the current economy that's playing out in front of me. Right. And you have to understand we need a hard reset. At this point, people are sheer gambling to try to survive. At this point, they're doing anything that they can to survive. And so with that being said, again, they're pricing in a ton this week. So again, shares, futures are what you would be trading in this environment until things correct and prices, and we get through a lot of this volatility. Once we price in a recession, I think options will get to a point to where they're tradable again. Last week was a good tradable week for options because there wasn't a lot going on, and then we still had some massive selling. Those are the weeks you want to be trading options, not a week like this where you're pricing in 133 points. You can move 120 points, and you bought put options and the market is selling like crazy and you're just burning cash and you're not making any money off what's going on. That's what happens with options, and why you need to be aware of the expected move. And also why I talk about these every week. So you know what is average and what is not. So with all that being said, if you made it this far, go ahead and drop a like. And until next time, I will see you guys later.